Hello, my name is Brian Moose. I'm a licensed accountant, and here we break down how businesses work. And today we are going to break down through case study this fundamental question: are AI companies profitable? Which, understandably, a lot of people care about right now. And so today I'm going to give you my view from the client work that I've done working with AI companies and working with SaaS companies more generally to kind of show you behind the scenes. So whether or not you are working for AI yourselves, or an AI company yourself, or you're just a financial lawyer who wants to know how these things work, welcome. But what inspired initially this video at all was this particular headline here that I saw, which is no commentary on the author or the site. Don't know really anything about them, have no other opinions. But we started, especially in the, starting at the beginning of this year. As you can see, this is a January article. But even towards the end of last year, we started seeing lots of articles about the failure rate of AI companies. And here, we have 95% of generative AI companies fail to deliver measurable ROI. We have also 90% of AI companies fail. Now, most people, it's no secret to most of you that startups have a high failure rate. It is the name of the entrepreneurial game. But when we start seeing things like this, and when things like 95% of generative AI companies fail to deliver measurable ROI, kind of to scratch my head because not delivering ROI does not mean you have failed. It's not really how the tech industry works, and it's certainly not how the SaaS industry works. And to tell you, and the reason why this is significant is that the burgeoning SaaS companies of today, AI SaaS, if you will, already understand how to optimize the SaaS business model. That's not a mystery, which is very much unlike the late 90s, early 2000s, where they were still operating off of different, fundamental assumptions on how business worked. We've answered those questions. We solved that. We know how to do or how to build a profitable and successful um, SaaS company, or company more broadly, whether or not you're building it just to cash flow for yourself or whether or not you're building it to eventually sale, which is most common. Or yeah, building for sale and or like say VC funding. So we have all these different variations of what SaaS is, what you do with a SaaS company. And we've solved that already, which means that to say that these AI companies are producing measurable ROI is fundamentally misrepresenting how these companies work. And so let's talk about the SaaS life cycle a little bit, just kind of from a 10,000-foot view. The first stage here of SaaS is your just initial development and investment. You are operating at a pure loss, and the development cycle for SaaS companies can be the smallest I've ever seen for an app that was built and profitable is about 12 hours of development. Um, I'm sure there's even smaller cases, but to maybe a couple of years. We often don't see much longer than 3 years, but a couple of years of development. And this is all just losses. This the first year or two for most companies. AI, or really LLMs, or even machine learning as we know it today, is only about 3 years old. ChatGPT came out 3 years ago. That's all we're really working with here. So like it's really hard to say that, if it's not delivering a measurable ROI, it's not failing. Well, it's not failing, it's just following the SaaS lifecycle. Because once you have a minimally viable product, an MVP, it's when you go to market. And that is you're just trying to generate income of any kind. And the failure rate that we see is around 38%. And this really just means that you have a solution without a problem. There's just not enough. There's just not enough interest in what you have, and so you fail. Your goal is to get through step one and step two as fast as possible, because if you can't do this, then nothing else matters, and you're just burning cash. So if we do kind of have a minimally viable product and it seems like there's interest in your company and you want to keep scaling, then next comes your CAC to LTV optimization. So your cost to acquire a customer versus the lifetime value of that customer. And your LTV has to be higher than your CAC. And I see this especially in much smaller SaaS companies that I work with. You don't have a good clarification on what your acquisition costs are or what your lifetime value costs are. And lifetime value and cohort analysis is all really, really powerful stuff. But most people don't do it. And part of it's just because of resources. That's fine. That's why I'm here, whatever. So this is really the optimization game. And you need to make sure that you know that at some point on each customer, you're going to start being profitable. Once you do that, those profits, that, is your gross margin, which then goes towards your operational costs. This is where most AI companies run into a hurdle. It's not because there isn't necessarily an interest in their product or a solution, or they haven't found a legitimate problem. It's because they have elevated costs. The cost of service for AI companies is actually quite a bit higher than your traditional SaaS. Server costs, your development costs, oftentimes the cost of developers is more expensive. And then you have just everything costs more. Because of that, it actually kind of eliminates some business models. For example, unless you're a massive player in this game, a freemium business model really isn't one that works well for SaaS or for AI companies, at least not that we've seen widely yet. Unlike, say, game apps, where it's all freemium and they just show you ads and sell you trinkets or whatever. Um, Setting all that aside, assuming assuming you make it through this gate, and at this point you're at the 10% level, you are just your only goal after this is to scale, which means that you pump all of your extra profit into SaaS or into ads or um, into like salespeople, however you're selling your product, whatever your business model is. It is important to note that this is still net zero. You do not actually post profits. In fact, it's one of those interesting things where when it comes to tax planning for SaaS companies, all of it happens like before you set up the company, like at the very beginning phases. And there's not a whole lot to do because you don't have a lot of profit to gain. And there are other nuances in there. I don't spend a lot of my time in tax, but this is just one of those things where it's like, yeah, you don't have a big taxable burden because you're not making money. All of your extra money just goes into scaling. And then at some point you sell or profit. And it's just you've reached some kind of saturation point, or your plans change, or you kind of reach whatever goal you have. And then you can stop trying to scale quite as fast and you can start making profits. The the time from step one here to step five can be a really, really long time. Most notably for Amazon, it took 10 years, 9 years and some change, but it took 10 years to get from kind of the initial online bookstore that Jeff Bezos was working on to when they were consistently breaking a profit, which I believe was 20 or 2003. And then it wasn't even until 12 years after that, when they had added on AWS, that they started making real profits, like real ROI on off of their investment, which is 25 years into the cycle. Mind you, we are still 3 years into AI. So there is a lot of time for this story to be told, and we'll see where this all goes. But with that, let's take a look over at our case study, our financial statements. So looking over this AI case study that I've looked up here, based off of some of the client work that I've done, keep in mind that this is not financial advice for you. If that's something you're looking for, go ahead and fill out the form in the description box, and I'd be happy to reach out to you and see what we can do to help you out. But breaking down this company, just some details. When I first came across them, they are about 18 months in. That's what these financial statements represent, though dates and other information have been changed to protect the innocent. Um, this will give you a pretty good idea of what these AI companies look like behind the scenes, as well as common problems that we face here in this world. Now, of course, you can tell this is definitely on the smaller side, which is totally fine. This is where a lot of innovation happens, and there are lots of small, successful companies, especially in SaaS. So kind of breaking through this, year 2024 is not actually remarkable in any way, because it's their first year. It's not they don't even have a full year, within 2024, and so like yeah, 42,000, that's great. Um, $15,000 loss by the time gross profit comes around. All that's of course due to contract labor, and you'll see, and there's basically nothing, just little things here, and then there's losses like $23,000. We'll get there. What we see though here for full year 2025 is that we have substantial growth, of course, to 180,000, and we have a gross profit margin or gross profit of not quite $150,000. Now, this is actually misleading, and let me show you why. And this will kind of explain this box that we have going on over here. Is that the current profit margin that we have here in 2025 is right around 80% with these figures. However, contract labor does not actually was not actually captured correctly, and this is actually very common that I see something that I see in smaller or even medium-sized financial statements is that they don't actually have their cogs broken out correctly. Because I could draw out here like software and apps should probably be in cogs. Most of these should be in cogs because this will include their compute costs. We also have payroll expenses here, which is pretty common. You have contractors that become employees, especially in tech. That's very, very common to see. And so, the least generous is that we put all these payroll expenses up there in COGS. Probably not all of them, but there probably are some developer costs up there. And so if we take the least favorable interpretation, we have a gross profit margin of 13%, which like congratulations, you actually have a gross profit margin. But we can see down there they actually were not turning a profit yet. Now, reflecting back on what we were just talking about, for SaaS, this actually isn't concerning. Per se, not at this phase and not necessarily for this company. Really, the only question that we really are trying to answer is how much runway do we have and how long will this round of funding, either from VC or just loans, how long will it last? And then, of course, here, the average gross profit margin right now the best figures I could find for AI is around 70%. So that's after your compute and your development costs, your contractors, right around 70%. Now, something that's really important to highlight now is that even though AI is a nascent industry, if you compare it to traditional SaaS, often those companies will have gross profit margins of somewhere between 80 and 90%, which it doesn't sound like a lot, but it is. It's actually a really, really big deal because it means that AI has to has to solve more problems. They have to be higher value problems to, I guess, your customers than what traditional tools are already available. It's very similar, actually, as I consider this problem, to the debate between electric cars versus gas powered cars, where powered cars are cheaper to make and they're cheaper to maintain and or fix and they're cheaper to run. They're just overall cheaper, and in part it's because the technology's been there a long, long time. And it also in parts that electric vehicles have carrying costs and have other troubles that no one really foresaw going into this, at least, or maybe saying that no one really advertised going into this. And so while electric vehicles have a use case, they don't have a super broad use case, not yet. And that's where AI I think might risk falling into. Because if I have a traditional SaaS tool, it's actually just cheaper. And because it's traditional SaaS, we have plenty of developers and we can understand the technology and we can understand the code. And though something goes wrong, it's easier to pull apart and fix. Um, that's going to be ultimately better for my customers than to use an AI tool that is more complicated, more expensive, and eventually there's just going to be a competitive balance here. And as of right now, it's not on the side of AI. This, of course, is to say that's never going to be this way. We just need a few AI companies to succeed, and we need a few good use cases for AI companies, and we're there. And that answers that question. That's an easy fight. But as of right now, from just like the physics of the money that I see behind this, traditional SaaS is cheaper. And is better understood, and that carries a lower price tag for your customers. And as AI companies really come onto the market, and if traditional SaaS wants to compete, it's just a price war. And if it really turns into a price war, then as of right now, it's kind of sitting on the side of traditional SaaS. That leaving all that aside, let's kind of pull down these expenses because I know you're probably curious here. Advertising, pretty modest, not necessarily unusual here. We do have commissions, which looks like they actually have a person who's calling, which wouldn't be surprising. So these contracts that they're selling are this AI company that we're working with here is primarily B2B, and they have contracts that are $5,000, maybe $9,000. They may be repeat, or they may just be one-offs that they're using. So, as they aim to scale that, it all just depends on getting your selling uh, up to where it should be. Merchant fees aren't anything unusual for this, for where we're at right now. This was a big line, though. To have a substantial increase in interest means that there should be a substantial increase in loans. We're going to put a pin in that. You'll see what my problems are with this in the when we get to the balance sheet section. Of course, software and apps probably shouldn't be here, or they need to be broken out between the administrative and like the selling side versus the actual development, the cog side. Same thing with payroll. What's administrative? What's development? Um, we do have a taxes paid line, which sometimes is appropriate, sometimes it's not. That's not an answer, or that's not something we are really going to explore here. But it does look like, though, we do have an S corp. We have an S corp structure based off of the way their financial statements, or at least their balance sheet, is organized. Of course, we have a total loss of about $30,000 here in year one, and then in year two we have a total loss of about $40,000. Like I said, at these early stages, not necessarily something that's really too concerning or overly concerning for us. Now, looking at our balance sheets, we do have it's smaller, and often tech company balance sheets are quite light. This isn't unusual. But we have, 13,000 at the end of last year, about 10,000 in bank, about 11,000 in the bank in this current year, and then we have AR balance of about 11.5, which is great, fantastic, love to see it. Um, Normal payroll, and this is then where we get our loan. So when they started this company, looks like rather than using VC, also not unusual when you're just developing, they have loans from someone. It may be an owner, it may not be an owner. Um, and so 43,000 looks like we about doubled that to 93,000. Fantastic. And then of course we have our equity section here, and that looks just fine. Nothing terribly unusual to see here. Well, we'll get to that. Just kind of picking this apart, of course, our first real question is how long is this going to last, or what is our runway? And frankly, it's not good. Um, it takes about $15,000 a month to run this thing. And maybe we should say we're running losses about $4,000 a month. It would look like if we normalize it, but that's not really how this business looks. So it looks like we have only a couple of months of runway. Our AR currently does pad that, so it's not awesome, but it's also not the worst place to be. We have time to work with, so it all really just depends on keeping business coming in. Nothing unusual for most businesses, though it doesn't necessarily feel very comfortable because it can fail quite quickly if these contracts do not actually end up cashing out. Now, when it comes to this loan payable, this is where we are really going to start running into trouble, and where if I see statements like this, we're actually going to really dig into, because if we have $93,000 outstanding and we paid $36,000 of interest on that, we're going to have a problem. Because that would imply a 30% interest rate, and either you had bad deal or we're going to fix your financing. The other option is that if we are using a loan from an owner, which is a very tax efficient way to get cash out of the business, you can't get away with a 30% interest rate. You just can't. I'm not an auditor, but any auditor is going to flag that, and you're going to probably get into trouble depending on how that's structured. So that's something that would need to be investigated much, much more closely. The second one here is that we have a conflict here between the shareholders, which there are two shareholders on this company, and this is one where we'd have to break out the operating agreement, because to get to the end of the year and you have one company who is paid in and we have one shareholder who is paid in and you have one shareholder who is cashed out, this is going to cause some conflict. These numbers normally look relatively similar, and if you get to the end of the year and you have not fulfilled the terms of your operating agreement, then something normally needs to happen to bring that into compliance with whatever your agreement is. So this is another area where I would want to make sure that that actually is what it should be. Besides that, that should give you a pretty good idea. Here's what a small team working on an AI company today in 2025, or as day of recording, early in 2026, what it looks like behind the scenes. If you have comments or questions, love to hear them in the comments. And of course, if you have a business that you'd like to have commentary on where I can go into much, much more detail for you, then go ahead and fill out the form below, and I will be in touch with you.